Hi everybody, and welcome back to Chapter 5. And here we're going to take a look at inventories and our cost of sales. Conceptually, we're going to identify those items and costs in merchandise inventory. Notice this is a merchandiser, not a manufacturing company. And we're going to take a look at our different kinds of inventory methods for both financial and tax reporting. Very important. And we're going to take a look at maybe some of the effects of those inventory errors on and future financial statements. And as usual, at the end of each chapter, we're going to take a look at a metric. In this case, inventory turnover and days sales of inventory. So let's take a look. We're going to look at the items in merchandise inventory here. So, what are those items? Merchandise inventory is going to include all the goods that a company owns and holds for sale, whether or not they are located regardless of whether the goods are located when inventory is counted. So you want to pay a little bit attention to that. Goods in transit, for example. Goods on consignment, damaged goods, or obsolete inventory. So we'll take a look at some of those. Goods in transit. Here, FOB, key term here. FOB stands for free on board. Oh, not exactly sure why it is called that, but FOB determines when transfer of title occurs for that inventory. So, the FOB shipping point means that the goods are included in the buyer's inventory when they are shipped. If you're the buyer, you're responsible for the shipping costs to your plant. Now, FOB destination means that the shipper is going to be responsible for those shipping costs, and they are going to be included in the buyer's inventory only after they arrive at the destination. But if it's FOB shipping point, those goods in transit are going to be part of the buyer's inventory. Here is a nice little depiction of that. Here's the seller, here's the goods in transit, and here's the buyer. FOB shipping point, that's when the ownership transfers at the shipping point. The buyer pays the freight. But over here, FOB destination, the seller pays that. Goods on consignment. Here, the consignor is the owner of the goods. The consignee sells the goods for the owner. So the merchandise is included in the inventory of the consignor, even though it would be present at the consignee's location. The consignee never reports consigned goods in their inventory. Damaged or obsolete goods are not reported in inventory if you can't sell them. They need to be written off to their net realizable value. Damaged or obsolete goods are sold then at inventory at their net realizable value. And what is net realizable value? That's equal to your sales minus your selling costs. Okay, and a loss is recorded when damaged or obsolescence occurs. We include all the expenditures necessary to bring an item to a saleable condition. So inventory is going to be the invoice cost, less any discounts, plus any other costs or expenses. We include that in inventory. Those other costs might include shipping costs, inbound shipping if it's FOB shipping point, storage, insurance, import duties, those kinds of things are all part of placing that asset in a saleable condition. The internal controls are important here when taking a physical count. Most companies take a physical count at the end of each year. And that physical count we then use to adjust the inventory account balance to its actual inventory available. So good internal controls include pre-numbered inventory tickets, counters that have no inventory responsibility. We don't want those counters to have a vested interest in distorting that inventory. And counters confirm the existence, amount, and condition of that inventory, and then a second count is taken by a different counter to confirm the accuracy of the original count. A manager then confirms all items are counted only once. 4 methods are used to assign costs to inventory and to cost of goods sold. This gets a little tricky, so I'll go through it with you. We have specific identification, FIFO as it's called, first in, first out, LIFO, last in, first out, and weighted average. So here's an example of FIFO. We buy these on May 6th, and May 1 was $45, May 3rd, $65, May 6th. So this is a period of rising costs. That's normal. So if it's FIFO, we're going to report the cost of goods sold as the first in, first out. So here's the first in. So that's going to assume that that cost of goods sold is going to be $45. The difference, that's going to be gross profit, the difference between net sales and cost of goods sold, gross profit, and that leaves me with $135 of inventory. Now, this total of $45 plus $135 is going to be $180. That's the total of all 3 of these layers. Now, if it's last in, first out, then we're going to sell the last in first. So there it is, $70. That means our gross profit, considerably different, is $30, and our inventory is less. But the combination of inventory plus cost of goods sold will still equal $180. And weighted average, we simply take the $180 here that we have for the sum of all 3 of those layers, divide it by 3. That means that each of those units costs $60 each. So we bring $60 here to cost of goods sold, and the remaining 2 units in inventory of $120. So that's a little overview of FIFO, LIFO, and weighted average. So this is a key graphic here. I love this graphic. We're going to start with beginning inventory. We'll add our net purchases, and that's going to be the merchandise available for sale as a merchandiser. That means 1 of 2 things is going to happen to it. Either we're going to sell it. If we sell it, it's included in cost of goods sold. If we keep it, it's in ending inventory. So, we're computing inventory in a perpetual system here using the methods of specific identification, FIFO, LIFO, and weighted average. Let's take a look at that. Specific identification, well, we'll get to that in a second. Inventory costs under a perpetual system, the balance sheet, ending inventory, and the income statement's cost of goods sold. Physical flow, important concept here, does not necessarily need to follow the cost flow. That's kind of difficult for most beginning students to get, but that's how we're going to do it here. All right, so when we're doing a perpetual inventory, and here we're going to talk about this scenario of purchases of bike inventory for trekking. And as you see, we bought different bikes at different costs during this month. And so our total available is going to be the sum of all these units. and our goods available for sale is going to be $59.90. We sold 43 of them at $130 and $150, but that doesn't have anything to do with our cost. That's our revenue. So our unit inventory at any point in time is given here. And the units left is going to be 12 units. No matter which method we use, it's always going to be 12 units, and the total available is always going to be 55 units, and the goods available is always going to be $59.90, and the goods sold is always going to be 43 units. It's how we cost them that's different between these methods. All right, so here, specific identification. Pretty easy here. We just identify what we sell, and we know the cost of those specific units here, 43 of them, and that's our cost. Very simple. And the ending inventory is going to be what's left, 12 units. And that costs out to $45.82 for cost of goods sold and $14.08 for our ending inventory. So, now let's take a look at first in, first out. The oldest costs go to cost of goods sold. The most recent costs are going to stay in inventory. So we're selling from the top down. That's the way I remember first in, first out. We sell from the top down. So if we walk through this a little bit, let's take a look at this example. For FIFO, we start out with beginning inventory, no magic there. We buy 15 units at 106, so we go to the next band. And in that band, we bring this row down to the first row of this next band, add our purchases, and now we're up to $2,500. Now, when we sell, we're going to be selling 20 units here. And so where do we get them? We work from the top down. So we're going to take 10 from this row and 10 from that row, here and here, totaling 1970. We're left with 5 from this row here. Then next, we bring this row down to the next band here, add this purchase of 20 units. We're up to 2830. Oops. Then we're going to bring this row down, add this purchase. Now on August 30th, we sell 23 units. Where do we get them? We work from the top down. We'll take this 5 from this row here, and we'll take 18 from this row here. That leaves us 2 units from this second row here, and all of the bottom row here, for a total of 1420. So now I have my ending inventory, or my cost of goods sold of $45.70. I have to add these two together to get that $45.70, and I'm left with this $14.20 as my ending inventory. And if I look at this little beauty together, it's still my $59.90. It will always total that $59.90. Okay? That looks like a good place for us to stop this video, and when we return, we'll take a look at LIFO. Until then, bye for now.